Believe it or not, millions of retirees live entirely off their investments and pay zero income tax. And no, this isn't a billionaire loophole or shady trick. It's completely legal, built right into the tax code. The catch: you need to start preparing before retirement. In this video, we'll show how millions of smart retirees structure their income. And stick around until the end because there's a lot of info to unpack here, and you want to grasp all of this as soon as possible. Most people assume they're doing the right thing by piling everything into a 401k or IRA, thinking they're maximizing their retirement savings. But what if that strategy isn't as favorable as it seems? Everything you've been told about tax-deferred accounts, it's only half the story. The truth is, most retirement money sits in traditional 401 kiloseconds and IAS, and those accounts come with rules that catch a lot of people off guard. Every dollar you take out is taxed as ordinary income, which is not so favorable for little old granny. That's because when you contributed, you got an upfront tax break. Contributions were deductible, lowering your taxable income at the time. The trade-off is simple, but often overlooked. You skip the tax bill then, and now you have to pay it when you withdraw. Now, the problem with this is the rate at which these withdrawals are taxed, even in the lowest bracket. That's at least 10% on every withdrawal. And if you take out too much at once, it could push you into a much higher tax bracket without you realizing it. 22%, 30%, or even 37%. It's a harsh reality for anyone who assumed tax deferred was the same as tax-free. And here's where things get really interesting. There are strategies that flip this script entirely, letting you keep far more of your retirement money instead of sending it straight to the IRS. Here's the part most people miss. Paying taxes now can actually save you tens of thousands later, but only if you know when and how to do it. A powerful yet often overlooked tool in your retirement toolbox is the Roth account. And it has the potential to completely change how you pay taxes in retirement. Unlike traditional accounts, a Roth flips the rules. You pay taxes now while working, and every dollar you withdraw later is completely tax-free. Both contributions and growth. Maxing out a Roth for decades could give you a seven-figure account where the IRS never touches another cent. The trade-off: no upfront deduction. You pay today for total freedom later. This works especially well for people who expect to be in a higher income tax bracket during retirement or anticipate the tax rates on traditional accounts like IAS or 401 kiloseconds could rise. There's also an interesting strategy called the Roth conversion, where you move money from a traditional IRA or 401k into a Roth. Timing is key. You pay taxes on the converted amount during that year. So many people choose low-income years to stay in the lowest tax bracket. In return, that money grows tax-free forever, and withdrawals in retirement are completely untaxed. No more guessing or worrying about what you owe. For example, imagine you retire early at 55 and have a traditional IRA with $1.2 million. That year, your only income is a small part-time job. So, your tax bracket is unusually low. You decide to convert $50,000 of your traditional IRA into a Roth. Because your income is low that year, you pay just 12% in taxes on the conversion. Instead of the 22% or higher you might face later in retirement, that $50,000 now grows completely tax-free, and every withdrawal in the future won't be taxed, giving you more flexibility and control over your retirement income. Just remember to pay the taxes with money outside the account. And if leaving money to heirs is part of your plan, Roths are especially valuable. Heirs inherit the account tax-free, unlike a traditional IRA. Now, you might assume rental income is always taxed, and technically it is. But the wealthy take advantage of unique deductions that can offset most of, if not all of their taxes, making real estate far more tax efficient than most people realize. You've got the usual deductions like mortgage interest, property taxes, and repairs. But one of the biggest is depreciation. Essentially, the IRS allows you to deduct the wear and tear of a residential property over time. For residential real estate, the standard is 27 and 2 years, meaning each year you can deduct about 1/27th of the property's value, not including the land. The IRS assumes the building will be worthless in 27.5 years, which is usually the exact opposite of reality. For example, if you buy a $500,000 rental home and the building itself, excluding the land, is valued at $450,000, you could deduct roughly $16,000 per year as depreciation. That $16,000 deduction lowers your taxable rental income, sometimes turning a profitable cash-flowing property into one that reports little or no taxable income, often showing a large loss on paper. Combine that with mortgage interest, property taxes, repairs, and maintenance, and it's easy to see how property owners can legally reduce or eliminate their taxable income. Unsurprisingly, it's not like you can just fly past go without paying $200 ever. If you sell a rental property, the IRS is going to want their share. You'll pay taxes in your profits, and any depreciation you claimed over the years gets recaptured. Fortunately, there's a way around this. If you sell the property, a 1031 exchange lets you defer capital gains taxes entirely by rolling the profits into another property, encouraging investors to continually defer taxes. For retirees who want steady cash flow with minimal taxes, rental real estate can be a powerful tool. Though, of course, it comes with the responsibilities of being a landlord. Now, if you thought that was clever, wait until you see the next strategy that rich people use. A favorite among the rich is using a taxable brokerage account, the regular investment account you might have outside of retirement plans. One of the advantages of these accounts is that the money you put in has already been taxed. Because you're investing with after-tax dollars, any gains you realize aren't treated the same as ordinary income, which remember starts at 12% and goes up to 37%. Instead, long-term capital gains tax rates range from 0 to 20% depending on your income. That's why in many cases, brokerage accounts can offer far more favorable tax treatment depending on your income and how long you hold the investments. For example, if your taxable income falls under certain thresholds in retirement, you may fall into the 0% long-term capital gains tax bracket. That means if you sell investments you've held for more than a year, you could pay zero federal tax on those gains. Qualified dividends, which are the most common type of dividends, are treated the same way. So they could also be tax-free if your income is low enough. Capital gains taxes are almost always lower than ordinary income taxes. If you play your cards right, you could reasonably fall into the 0% capital gains tax bracket. The flexibility in differing tax treatment is exactly why you often hear people say contribute just enough to a 401k to get the company match, then invest the rest elsewhere. The idea is simple. You don't want to overload traditional retirement accounts and lock yourself into paying higher taxes later. Instead, you can diversify into more tax-favorable accounts, giving yourself flexibility and control over your income in retirement. Some money grows tax-free, some benefits from lower long-term capital gains tax rates, and some could even generate deductions with depreciation. The tax code is always changing, and this is how things currently stand. Instead of trying to memorize every rule, it's smarter to understand the principles behind these strategies so you can adapt as the laws evolve. Now, let's be clear. When we talk about paying zero taxes in retirement, we're referring to federal income taxes. You may still owe state taxes depending on where you live. Even at the federal level, paying zero tax isn't realistic for everyone, and in many cases, it shouldn't even be the goal. If you save well and build up significant assets in tax-deferred accounts, you're probably going to owe something, and that's not necessarily bad. It's possible that would result in fewer overall taxes paid. The real goal is to be intentional about where you pull money from, in what order, and how much you withdraw each year, so you're not accidentally overpaying Uncle Sam. That's why it's so important to start thinking about this now before you retire, not once you're already there. And here's the important takeaway. Don't try to do this all alone. Retirement tax planning is complicated, and it gets even trickier if you have multiple income sources like Social Security, pensions, rental income, dividends, and capital gains. Working with a qualified CPA or financial planner can make the difference between paying thousands in unnecessary taxes and keeping more of your money. For example, a tax professional might charge $2,000 for a year of planning. But by carefully timing Roth conversions and capital gains sales could save you $20,000 in taxes. A good CPA can help you map out withdrawal strategies, maximize tax-free income, and stay on top of new laws so you're never caught off guard. In short, retirees who carefully utilize Roth IRAs, taxable brokerage accounts, and rental real estate can potentially pay zero federal income tax. You might draw from a Roth, use gains from a brokerage account in the 0% capital gains bracket, and offset rental income with depreciation. The key isn't any single account. It's how you balance them all. So, which of these strategies could make the biggest difference for your retirement? Let us know in the comments.